Welcome, everybody, and thanks for joining us for another installment of the Options Industry Council's monthly webinar program. My name is Ed Modla, the Executive Director of Investor Education. I'll be your instructor today on the topic of understanding the iron condor. Just briefly about my background, I got started in the options business in the late 1990s as a market maker on the trading floors of both Chicago and New York. Once the industry turned electronic, I was a professional trader electronically for, across stocks, options, and futures for a number of years. But now going on 7 years, I've been fortunate enough to work for the OCC team. That's the Options Clearing Corporation within their investor education department known as the Options Industry Council. More on us in just a second. First, our disclaimer. Options are not suitable for everyone. They are a rather complex tool that needs to be well understood before being used in a live account. And for those of you new to our presentations, OIC was founded back in 1992 as an industry cooperative. Most notably, we provide free education. We can't take your money for anything. We have nothing to sell. We're not a brokerage. We don't sell data. We don't sell advisory services. We are strictly education, hence the name Options Education. That's our website, optionseducation.org. You can find some archived courses, some new courses we're building out we're very excited about, podcasts, videos, and previous webinars just like this one that we do every single month. Also, we have the investor education team, which can be reached by email at options@theocc.com. Feel free to send your questions to the team about options, or if you have questions about what we have on our website, upcoming events, send questions to the team and we'll help you out. Speaking of which, we do have members of the investor education team behind the scenes, live on board to answer questions today. So do not be shy about sending your questions through during the presentation today. And when I'm done with the presentation, it should take about 40 minutes or so, I'm going to bring one of our team members, one of our instructors, Ken Keating, on the air with me to handle some Q&A there. So hopefully you'll have some questions for us to address. Again, about 40 minutes of education, and then hopefully we can deal with your questions for the remaining time frame after that. The outline for today, I'm going to start with some broad comments about spreads and vertical spread, and then we'll get into the strategies that will define and pick apart today. That's the call credit spread, put credit spread, and then we'll spend some time on the iron condor. Also here at the end, stick around. I'm going to talk about some variations and some intricacies of the iron condor. I think it's always helpful to look at ways to tweak or tailor a strategy that's a bit more to your liking. We all can understand what certain strategies are by name. We know condor, butterfly, straddle, strangles. We know what they are, and we can get on the same page. But when you're putting real money on the line in a live account, it is common to take that classic definition or fundamental understanding of a strategy and do something else with it. Change it a little bit because it fits your market outlook or your risk tolerance just a little bit better. The majority of what I walk through today, I would say, is more or less on the basic level. If you're newer to options, you certainly will learn a lot today. But if you are more seasoned, I think there's going to be plenty in here for you as well. First of all, let's talk about spread. And you might hear different definitions from different people on what exactly it means to say options spread. Believe it or not, depending on what firm or what school of thought you came from, you could have some options concepts that are taught just a bit differently. So one person might say a spread involves an option versus another option, and you have to have two options involved. I was taught when I started going on 25 years ago that spreads could also just involve a stock position versus one option. Think of covered call or protective put. Two positions, even though one of them is stock and one is an option, I consider that a spread as well. For our purposes here today, and for a lot of option spreads, it involves one option versus another. And we'll start talking about two options, two legs in the spread, and then we'll expand it from there when we get to the iron condor. Most likely the same underlying stock. It is possible that you have a pairs trader who's trading one stock versus another, but most likely it's the same underlying stock. Most often it's the same expiration dates. Of course, there could be calendar spreads or diagonals that deviate from this, but most of the time same expiration dates are used. Also, most of the time it's different strike prices. If you're familiar with straddles, that would be an exception to this, but most often different strikes. And here's where things get interesting, possibly different quantities. Now, this could be by design. There could be ratio spreads, 1/2s and 2/3s that are designed to use different quantities, or reflecting on the point that I made just a minute ago about tweaking a strategy to your liking. It is certainly possible that when you're buying and selling options, you as an investor in a particular situation decide you want to buy more of one of the options in the spread, or you want to sell more of one of the options in the spread. And that changes the complexion to look different from what the title represents, but it changes it in such a way that benefits your market outlook and risk tolerance. And that's often where different quantities come from. For today's purposes, we're going to start by talking vertical spread. And the name vertical simply comes from the aspect of staying in the same expiration date, and then looking up and down vertically across the strike prices to buy one of the options and sell another option. So two pieces, two sides, buying one, selling another. Both of them will either be call options or put options. We're not mixing and matching here. So both calls, both puts, you buy one, you sell another at different strike prices. And one of the key features here for vertical spreads, as you'll see today, is you get this defined risk-reward characteristic. Now, there's 4 types of vertical spreads. Let me pick apart these 4. Let's start with the debit spreads. Debit, of course, means you're incurring a cash debit at the outset, and you could have a call debit spread or put debit spread. Focusing on calls for just a minute, if you're paying for the spread, a net debit, then you are buying the more expensive or lower striked call option and selling the higher strike, less expensive call option. That's going to be a net debit. For those of you who are familiar and comfortable with Greeks, here's something for you. If you buy the more expensive lower strike call, you are long delta. You are net long delta with a call debit spread. Long delta means you are bullish on the underlying. And let me clarify long and short briefly here. In the options space, the terms long and short really have 2 different definitions. On one hand, you could say buying an option, regardless of what direction, you buy calls, you buy puts. If you're just a buyer of an option, then you are long the contract. And if you're the seller of the option, then you are short the contract. That use of the long-short terms has nothing to do with market direction, bullish or bearish, or market bias. But when you put it in terms of delta, long delta is bullish. Your position will benefit from the stock going higher. Short delta is bearish, benefiting from the stock moving lower. So the call debit spread is long delta and is bullish in nature. Keep that in mind. The put debit spread involves buying the higher strike, more expensive put option and selling the lower strike, less expensive option. We are a net buyer, paying a debit, and we're buying the option that has the higher delta. The higher strike put has the higher delta. And when you buy puts, you are taking on a short delta trade. So put options on the debit side are short deltas. Keep those in mind. Call debit is long delta. Put debit spread is short delta. Now, how does that compare to the credit spread? The call credit spread means we're receiving a net credit. We're selling the lower strike, more expensive call and buying the higher strike, less expensive call. A net credit to our account, that's cash we receive up front, and we are now a net seller of calls. Putting it in terms of delta, that's short delta, net short delta on the calls. The counterpart was the debit put spread. I said that was short delta. On this side with the credit spreads, calls is short delta. Keep that in mind as I finish this up. The put credit spread involves selling a higher strike put and buying a lower strike put. Selling the more expensive option, buying the less expensive. You are a net seller of puts. And when you sell puts, that's long delta, the long delta counterpart here on the call side of the debit spread. So calls translate, the debit call spread translates to a credit put spread with respect to delta. Those are the counterparts. So why would you do one versus the other? Some people might do a debit spread. Some might do a credit spread. So why would you distinguish between the two? And I'll explain this by and large as the difference between buyers of options in general and sellers of options. Debit spreads or paying for options is a more aggressive trade, usually done with the investor who has more confidence in their directional market outlook. When you are paying for options or doing a debit spread, you need the stock to move in your favor. It has to occur. Leaving volatility out of this for the moment, the stock has to move in your favor by a certain magnitude within a certain time frame in order to be profitable. If that doesn't happen, then you could suffer a loss of your entire investment. In exchange for that, you get a better risk-reward profile. If the trade does work out in your favor, you can get very strong returns on your investment with these debit spreads or with buying options. On the other hand, the credit spread is going to give you a greater likelihood of being successful. As we see through the examples today, the credit spreads yield a favorable break-even point. We have the ability to profit in more than just one market environment. We don't need the stock to go anywhere to be profitable. The credit spread is a higher likelihood of success. And in exchange for that, the risk-reward profile that we're going to see when we look through these verticals is going to be the opposite of debit spreads. We will risk potentially more than we could make. So there's a lot about debits versus credits, buyers versus sellers, and we'll comment on that as we go through. But now let's start with the first strategy of today, the call credit spread. Remember, we're short delta here. We're net receiving cash. That's bearish in nature. But with the credit spread, we also have this element of being neutral and or bearish on the underlying. For debit spreads, just to sort of button that up, for debit spreads, this neutral aspect is not going to work out for the option buyer. The investor who's bearish, who does a debit spread, say the put debit spread, they need that bearish outlook to come to fruition. The call credit spread seller can capitalize on that bearish move, or a neutral move even has a little bit of a buffer, and that's what we mean by favorable break-even point on the positive side of where the stock currently is. We'll see that on the P&L graph in just a second. And a key feature of vertical spreads and some of these defined risk strategies that options offer, you can precisely calculate the profit potential of the trade, the maximum potential loss. But as we'll see walking through the different situations, position monitoring certainly is critical, and there might be decisions that you have to make to manage the position appropriately. Let's look at our example. You'll see these consistent numbers throughout the presentation today to keep things consistent. Stock XYZ is at 88.5, about a month till expiration. And this investor is more or less bearish. Maybe they're a bit neutral, but if anything, they think the stock is moving lower, certainly not bullish. And there's a number of different strategies you can employ here, but we'll choose the call credit spread to try and capitalize on this market outlook, selling the 90 strike price call and receiving $3.50, and then covering that risk by buying the 95 strike call for $1.80, receiving a net credit of $1.70. Now let's talk about strike price selection briefly. How did we come to 90? Generally speaking, you sell an option. You are selecting the strike price at which you believe the stock might get to, but it's not going to break through that level. Maybe 90 is a resistance level that you've identified, and from its current level of 88.5, you think the stock could conceivably get up to 90. You could see that happening, but really don't think it's going above 90. That's the highest I think this might get. And there becomes your strike selection on the short call. Lower than 90, you're being more aggressive, and you think the stock is going to stay beneath that level. So here we select 90 to sell our call. How did we choose 95? Well, this is all about risk tolerance. If we felt more confident in this trade, for example, we really felt like the stock was going to consolidate here or move lower, and we were very confident in that, we might choose a higher strike price than 95, for example. We'll go up to the 100 strike and buy that call option and pay less for it and have a net credit that's higher, a greater potential reward, although that comes along with the potential for much greater loss because our protection is going to be at a higher level. That would be more aggressive, more confident in your market outlook. In our case here, we select 95. We're comfortable with that level. We pay $1.80 for that, and there is our net credit of $1.70. Let's get into a little bit of math now, and I'll start with just I'll quiz the audience here before I show the numbers. What I want to get through looking at our example is, what is the maximum potential gain of this spread? What is the maximum loss while the spread is open and exists? And what's the break-even point? So think about that. I'll come back in about 10 seconds and show the numbers. What's the maximum gain, maximum risk, and break-even point of this call credit spread? Let's start with the max gain. As we know, when we sell options, the best we can hope for is that the value of the option, or in this case, the spread, goes to zero. Can't go any lower than zero. So the credit received up front is going to be our maximum gain of $1.70. The maximum risk can be easily calculated. What's the worst that can happen? The worst that can happen is that we're wrong in our market direction. The stock price rallies specifically up to 95 or above, and these options then become subject to the exercise and assignment process. Remember what it means to sell a call at the strike price of 90. We are obligated to sell or deliver shares at 90. We have purchased the right to buy them back at 95. That's that protective element of the long call. If that were to happen, then we have given back $5 to the market, sold shares at 90, bought them back at 95. That's giving $5 back. We were paid $1.70 up front. That's ours to keep. So $5 minus that net credit up front, and you have your max risk of $3.30. That margin here, just to keep it on your mind when you're selling options, you have to consider a margin requirement of your brokerage firm, and this is roughly going to be equal to your maximum risk. I suppose from one firm to the next, they could treat this a bit differently because there is a short call option in there. And if you don't manage it appropriately, that could change your risk profile. Some firms that are a little bit more conservative might charge more than this. But there could be a margin there you have to consider. So that's why I have it in here. And then break even, I'm going to calculate this when we get to the next slide, but 91.70. If you didn't get that right, think about it, and I'll walk through it in just a second. But one of the common questions that comes up is, what is this spread worth with the stock at 88.5 in 3 weeks or in 1 week? Or what if the stock goes to 89 or 87, goes to somewhere else? What is this spread going to be worth? And the answer is you really don't know. When you put P&L graphs, and I'll just start with it right now, we'll go there. These profit and loss graphs, and we're going to see a number of them today, they're all drawn with the expectation that we have already reached expiration. And that's because at expiration, there's no more time value left in the price of the options contract. Another way to say that is the element of volatility or future stock price movements doesn't matter anymore once you've reached expiration. So given a certain stock price, you can precisely calculate what each of the options is worth and then draw a profit and loss graph. Prior to expiration, it's an imperfect science. However, you can estimate what the value of your option or spread might be by using a calculator. We've got one on our website. If you go to the quotes and calculators section of the OIC website, you can pull up our options calculator, and then forecast a certain stock price in the future. Change the days to expiration to however far out you want to look. You will have to input an implied volatility assumption, some estimation of what volatility level the market might be using at that point in time. That's the uncertain part of the calculation, but insert something there and then calculate a theoretical, hypothetical value for what your option or your spread might be worth in the future. You certainly can do that. For our graphs here today, we're assuming we are at expiration, and I told you I'd walk through that break-even point. We sold the spread for $1.70. Question is, at what stock price at expiration do we give back that $1.70? Remember, we sold the 90 call. We are obligated to sell shares at that level. If the stock is $1.70 above 90, then we have reached our break-even point at expiration. Now, can you see what I mean here when I had said earlier that the break-even point for these credit spreads is favorable? Does that come through now? Do you see what I mean there? Don't forget, the stock in our example was at 88.5. Stock's over here, and we have a neutral to bearish outlook. Stock's at 88.5. Well, the stock could move lower. We reach our max gain. The stock can actually move a little higher, can consolidate, max gain. We don't lose unless we're wrong by $3.20 to the wrong side. All the way up here is our break-even point. That's what I mean by favorable break-even. Debit spreads have the opposite. Your break-even point is going to be on the other side, and you're going to need the stock to move where you think it's going to move in order to be profitable. For credit spreads, you have this favorable aspect to where the break-even is. And what do you get in return for that? Well, you're going to possibly lose more than you can make. And that's what you give up with the credit spread. Debit spreads, again, will likely be the opposite of that. Because your break-even point is flipped for debit spreads, you could potentially make more than you would stand to lose and have a much better percentage return on your trade. Although the likelihood of being profitable is on the side of the credit spread. Now let's pick apart what happens at the various levels at expiration if the stock is below 90. And this is ideal for us. The stock stays below our strike prices. Options could expire worthless here, and we reach our max gain of $1.70, and then no position results after expiration. One thing to point out is the assignment risk that exists if the stock is close to 90. This is also called the pin risk of option sellers, and it has to do with the uncertainty that your 90 call could be assigned. Remember, the option buyer has the right to buy shares at 90, regardless of where the stock is trading. The stock doesn't have to be above 90. They can choose to exercise their right for whatever reason they wish, even if it's not in their financial best interest. So if we're on expiration day and the stock is trading 89 and all of a sudden it starts ticking higher and it ends up closing the day at $89.90, there's some risk there being short the 90 call, because what if the option holder watches a little bit of the after hours activity and the stock starts trading above 90? That option holder can certainly exercise their right to buy stock, and we could potentially be assigned and short stock, which likely we don't want to have. The way to avoid that, you'll hear me say this a few times today, the way to avoid a stock position that we don't want to have is to close out the open short assignable position, buy back the 90 calls, eliminate the possibility of being assigned, and then avoiding the pin risk. We may have to pay for that, certainly, but that avoids that element of pin risk. If the stock is above our strike prices, then this is, of course, what we don't want to happen. We were neutral to bearish. Stock rallied significantly. Both of these options are subject to exercise and assignment, potentially selling shares at 90, and then we have the right to buy them back at 95. We have our maximum loss and no position remains. No options, no stock, no nothing. Now, with respect to pin risk, we don't have pin risk because we're long this strike. Pin risk only exists for option sellers. In this example here, we are in control. We have the 95 strike. We own the right to exercise it if we choose to do so. If the stock is close here to 95, just above it, and you want to make sure it gets exercised to cover the risk of being assigned, then it might be a good idea to make sure to proactively communicate those instructions to your firm. If you're not sure about exercising, the stock is dangling around here, then you might want to look into possibly closing out that spread and just getting rid of this uncertainty of having a stock position you don't want. Now, all of that uncertainty and pin risk really gets highlighted in this circumstance with the stock in between 90 and 95. Now we need to do something. If we do nothing here, then it is very likely that it will be assigned on the 90s. The 95s will just expire and go away, and we'll be left with a short stock position. Now, remember I said at the beginning, these vertical spreads and many option spreads, they have defined risk. You see it right here. We know exactly how much we can make, exactly how much we can lose. That's why the options pieces are in place. If this is subject to assignment and a stock position results from the options trade, then all of a sudden that defined risk is gone, and we'd have short stock with significant upside exposure, margin requirement on that short stock position. Most investors don't want to deal with that. So again here, position management, closing out the short assignable position to eliminate that risk. Profitability of this trade will be determined on where exactly is the stock within this range. Can we buy back the 90 call for $1.70 or less or more? And profitability would be determined from there. Now let's switch gears. We talked quite a bit there about the call credit spread. Let's look at the put credit spread. And refreshing your memories on this, selling the higher strike, higher delta put is a long delta spread. So the motivation for this options investor is to be neutral or bullish, and long delta bullish on the underlying. And because it's a credit spread and we're selling options, that neutral element is there. I'm going to walk through the put credit spread a little quicker than I did the calls because this looks the same. And hopefully you see the same things here. Just flipping it around from the put perspective. So hopefully this will go a little quicker. But that neutral aspect is there because we're doing a credit spread. If it was a debit spread, the counterpart bullish debit spread is buying a call spread. We're not going to have that neutral motivation. We need the bullish move. But the credit spread that we're doing on the put side can be profitable in a neutral environment. We'll see that element of favorable break-even point again from the put side, and then that defined risk, profit potential, max loss, all of that is clearly defined. I'm going to keep the same stock price for our examples today because it'll make things a little bit more clear. So 88.5 is our stock, 28 days left until expiration, and we start by selling the higher strike 85 put option, the more expensive strike of the two, buying for protection the 80 strike put option for 70 cents. Net credit here of $1.35. Same thing with respect to strike selection. The short strike is chosen at the level that you believe the stock might pull down to. It might actually sell off a bit down, potentially to 85, but it's not going to go below that level, and that becomes the strike that you sell. Now, as for the long strike, similar to the description of the calls, the long strike is there to protect. So after we've decided what's the short strike that we want, we then start to look down at the 82 strike, the 80 strike, the 75. We see how much we'd have to pay for those options. What does that mean for our net credit and our risk profile? And we decide the appropriate level. So here we're buying the 80 put to protect against the short 85 put. And let's ask those questions again. Selling the 85-80 put credit spread at $1.35, I'll give you 10 seconds or so. What's the maximum gain on the spread? What is the maximum risk of the spread? And what is the break-even point? I'll put those numbers up in just a few seconds. Hopefully, if you got that from the call spread that we did, selling options, the best thing that can happen is price goes to zero. So put credit spread sold at $1.35 means the max gain is $1.35. The maximum risk, what's the worst that can happen is this stock sells off significantly. It goes all the way below our 80 level. We are obligated to buy shares at the strike of the short put at 85. We've protected that risk by buying the right to sell those shares at 80. If that were to happen, we'd give $5 back to the market. $1.35 was ours, paid to us up front, cash immediately into our account. If we then give back $5, we have our maximum risk of $3.65 and break even. I'll talk through that here. At what stock price at expiration do we give back the $1.35 credit we received up front, reflecting back on the obligation to buy stock at 85. If to pay 85 and the stock is $1.35 less than that, that becomes our break-even point, which we'll see on the risk profile. And then what's the spread worth at various stock levels in the future? If you want to try to forecast that, a calculator will certainly help you out. Now, as we look at the P&L graph that we just walked through these numbers, again, I want to highlight one of the key aspects of credit spreads. The stock is up here at 88.5. Now, we're neutral to bullish. If the stock stays around 88.5, we reach our maximum profit. If the stock rallies, which we think it might, we have max gain. If we're wrong and the stock sells off, at expiration, the shares have to be all the way down here to 83.65, below which we start to experience losses. That is a nice wide range of profitability. It's what I mean by saying a high likelihood of being successful on the trade, because not only can we be wrong, but we've got a buffer here before we reach break even. So a nice range of profitability, and hopefully if our market outlook is correct, the trade will be profitable. In exchange for that, a very favorable break-even point, we could lose quite a bit more than we could make. And that risk-reward is, we'll say, skewed against us, with the maximum potential loss significantly higher than the maximum profit. At expiration, if the stock is above 85, the options expire worthless. This is what we want to happen. If the options expire and there is no exercise and assignment activity, they just disappear. We have no position left. We have our maximum profit of $1.35. That assignment risk, again, exists here on the short option. If the stock is very close to our short put at 85, we have to think about whether or not we're going to be assigned, and can we tolerate being assigned. If we cannot, then we would need to buy back that open short assignable position, buy to close the put option, and eliminate that assignment or in risk. Stock below 80 at expiration, both options are subject to exercise and assignment. We are short the 85 put, obligated to buy stock at that level. We have the right to sell those shares at 80. That's the protective aspect of the 80 put, giving back $5 to the market, maximum loss of $3.65. And a little different here. I'll explain this a bit differently than I did the call side. With the stock between 80 and 85, we are certainly subject to assignment on the 85s. We probably will not exercise our right to sell stock at 80 if the shares are up above that at 82, 83, 84. So we have risk here of being assigned and ending up with a long stock position. But the slight distinction on the put side is, sometimes investors might think, well, I don't mind buying the stock. For whatever reason, the stock's maybe drifted lower, and all of a sudden you've become much more bullish. And this is the key aspect to accepting assignment here. Compared to when you initiated this trade, you are now much more bullish as the stock has sold off down here 83, 82. Maybe it found support somewhere, and it's now starting to bounce. And you might consider taking assignment and buying the stock, having a long stock position, and then doing something with that. Maybe you do a protective put, maybe you do a covered call. But you can then consider taking on that stock position and managing it from there. Just be careful and make sure you're not doing that just to avoid a loss, that you are indeed more aggressively bullish on your outlook. That's the difference here between, say, calls where you're probably not going to want a short stock position to result from assignment. But on the put side, with assignment meaning buy shares, you certainly could consider that if you had the cash, you were willing to commit the capital, and your market outlook has turned to be much more bullish than it was before. So there's the two vertical credit spreads, and we're now going to translate into the Iron Condor, look at the risk profile here, and a few of the key elements of the Iron Condor that make it a pretty popular option strategy. First of all, let's take a look at the motivation. And previously with the call credit, put credit spread, we had said that there was that neutral element along with a directional bias, neutral or bullish, neutral or bearish. Well, with the Iron Condor, you don't have the directional bias at all. You are truly neutral. And you believe the stock is going to be range bound within a certain time frame. This could be a stock that's trading in a channel, it's trading in between support and resistance levels. For whatever reason, whatever analysis you're doing, you believe the stock is going to be range bound in between a couple of different levels. So instead of just doing one of those vertical spreads, you're now going to do the Iron Condor to capitalize on a range bound stock. And this is where the Iron Condor is utilized. So what is the Iron Condor? Reflecting on what we've just done, it is a combination of the sale of a call credit spread and the sale of a put credit spread. Both of those strategies that we just walked through today in great detail merged together. 4 options pieces combined into one strategy. The same underlying will certainly be used, same expiration month, both spreads using out-of-the-money options. And to refresh your memory, that's the call credit spread. Here's your put credit spread. And now we're going to merge these together. Now, with respect to execution, before we bring the example and risk profile of this strategy up on the screen, when you execute the call and the put credit spread, remember 4 sides, it is certainly likely and common to do all 4 sides at once. Your brokerage platform may actually have a drop-down strategy called Iron Condor that sort of fills in the blanks for you, and then you can just select strike prices and the net prices for your execution. But executing them all at once is certainly very common. If you did that, again, you'd put in your 4 strikes, what you were buying to open, what you're buying to close. Again, your platform might fill in some of that for you. And then you would put in a singular amount, a singular number for a net credit that you were looking to achieve across all 4 of those transactions done simultaneously. You don't have to do them all at once. You could sort of, what we say, leg into the Iron Condor one piece at a time. I'll talk about that in just a minute. Let's get back to our example and see how the Iron Condor compares to the strategies that we walked through a bit earlier. Stock here at 88.5, same price as before, but now instead of having a neutral opinion that is attached with a directional bias, we are truly neutral with the expected price range between 85 and 90. There is strong support at 85, strong resistance at 90. Stock's going to stay there for a while, and you want to capitalize on that while having protection in place in case you're wrong and it breaks out of those levels. That is the Iron Condor situation, selling both spreads. This is the same exact spreads we talked about earlier, a 90.95 call credit spread for $1.70, 85.80 put credit spread for $1.35, selling both of them at a net credit of 305. And again, when you're entering this into your platform, if you wanted 305, we just put in that singular number, sell to open the 90 call, sell to open the 85 put, buy to open the 95 call, buy to open the 80 put. Net credit for all of that, 305. One number, one transaction, try to get all four pieces of that trade executed simultaneously. So this is, I will say, is a typical iron condor. Now, what do I mean by typical? Well, here you have the width of the strike price is more or less equal. Well, exactly equal. $5 wide, $5 wide. That's pretty common when you're doing iron condors. You also have your short strikes centered around where the stock is. Said that earlier, using out-of-the-money options. They don't have to be exactly centered. They're not here, but more or less centered around where the stock is, and then that width of $5 wide on each side. That's typical. You don't have to do it that way. And again, at the end, we'll talk about those variations. But here you have the 90-95 call spread, 85-80 put spread. You sold both for 305. Last quiz of the day. I won't give you too long to go through this, but what's the max gain? What's the max risk? And what is break even? How do you calculate break even? Take a few seconds to think about that. Max gain, max risk, break even. And then I'll put the numbers up here in just a second. Well, just like before, we're selling options here. We're doing a credit spread. We received 305 up front. That's ours to keep. The best that can happen is all the options expire worthless, and we keep 305. The max gain is $3.05. As far as max risk is concerned, a big move in the stock is going to hurt us, but the stock can't be in two places at once. It can't rally and sell off. We can't be hurt twice unless we close something out, unfortunately. But the stock can only end up in one spot or the other. So as it's constructed, we could potentially have to give back $5 on the upside, the same way we walked through it before, give back $5 on the upside, or give back $5 on the downside if the stock were to sell off. Exactly the same calculations as when we walked through these vertical spreads in their isolated fashion. If that were to happen and we gave back $5 on either one of those sides, remember we received 305 because we sold both of them. So maximum risk here is $1.95. Notice we flipped the max gain, max risk around to be in our favor. We now could potentially make more than we stand to lose. And in exchange for that, you're always exchanging something with options. You know, should I do this or should I do that? Should I change this, change that? Whenever you're thinking about what you're doing and you have a benefit associated with it, there's always going to be a risk. There's a cost and a benefit that you have to realize. And if you can't see both sides of that, keep looking. Here we have the gain and risk flipped in our favor, but of course now we stand to potentially lose if the stock moves in either direction. We can lose on the upside, we can lose on the downside. That also means we'll have two break-even points. So let's see how that looks. Here's our trade, call spread, put spread, net credit, 305. This is the P&L graph, by the way. In between the short strikes, all of the options will expire out of the money and worthless. That is exactly what we hope and expect to happen. If that were to happen, we'd have our net gain of 305. Below the 80s or above the 95s, those are the situations where we would give back $5 to the market and experience that loss of $1.95. So break even. Where do we break even? On the upside and the downside, it is the stock price at expiration where we give back the $3.05 credit we received up front. If we are short the 90 calls, obligated to sell stock at that level, and this is going to be $3.05 above that level. On the downside, if we're obligated to buy shares at 85, break even down here will be $3.05 below that level. Two break-even points, and what you can see here with the construction of this iron condor, why it's a popular trade, is this is a nice wide margin. You know, roughly 82 to 93 is your profitable range. You stand to potentially make more than you can lose, and your max gain also has a decent range in between it. If you can get it right on the neutral market outlook and select short call and short put strikes, where the stock does not break through either side, then this can work out to be a nice trade for you. But in exchange for all of that nice profitable range, a decent range of maximum gain, a better risk-reward profile compared to the verticals outright, we now could lose if the stock moves in either direction. And you have to make sure that neutral outlook is exactly what you expect to happen. Now let's talk about a few variations of the strategy. I had mentioned legging into the spread rather than execute all four pieces at once. Legging into the spread might be something you consider if, say, the stock's trading at 90 and that is the resistance level, and you think the stock is going to sell off from here. More or less consistent with doing a call credit spread only. Your mindset is really call credit spread on this. Sell the call spread first with the neutral to bearish outlook. But if you're right and the stock does retrace down to its support level of 85, now you're at support and your mindset has shifted to neutral to bullish because it's trading back and forth between support and resistance. So when the stock sells off, then you implement the put spread side of things and should get a better price than you would have if you implemented the put spread initially with the stock up at 90. So you can leg into this iron condor if you think the stock is bouncing between two levels and it's at one of the extremes. If it's down at 85 and you think it's going to bounce from here, you could sell the put spread first. Once it gets up to 90, see how it looks. If you still think it's the range that you were thinking, then go ahead and sell the call spread. Leg into it. Something else you can do is staggering quantities. If you are more confident, say the stock's at 88.5, where our example is, and you were much more confident, you think this range is there, but you're much more confident that it's not going higher. Yet, if anything, this stock might go lower. I really do think 85 to 90 is going to hold. I'm much more confident on this upside holding. Well, then you can tweak the iron condor and maybe sell more of these spreads. If you're trading more than just one lot quantities, you can sell two of these or three of these and sell one of these or two of these. Sell more on the side that you think the stock is not going to go. And then the last, not the last, I'll say two more. One other variation is to break up the strike prices. Again, if you were more confident that the stock was not going higher, then you might not want to pay for the 95 call. You might break the strikes, have 85, 80 on the downside, and have 90 and 100 on the upside. Again, if you're more confident that the stock is not going to rally versus your opinion that the stock will sell off, then you could widen the strikes on the side that you do not think the stock is going to go, or you're more confident the stock won't go in that direction versus the other. And then the last variation I will mention, this is for those of you who are familiar with volatility skew and the fact that lower strike prices most often generally trade at higher implied volatility levels and therefore higher prices. It's more or less just due to the protective nature of put options and a little bit higher demand for put. If you're familiar with that and you're tracking volatility levels, you'll notice if that's the case, the classic volatility skew is in place for the stock that you're trading. Amongst these four options, 80 put would have the highest implied volatility level, and you're buying that option. You might not be comfortable buying the option that has the highest implied volatility level. Some investors would tell you that that means it's the most expensive option of the four. And if that is something you're concerned about, then you could leave off the long put, accept the downside risk of not having protection down here, and then sell the interiors, buy protection on the upside. Again, if you're trading more quantity, 2 lots, 5 lots, 10 lots, you can then further consider maybe buying less of the 80 puts. You would have exposure here and more risk, but potentially improve your credit, your cost, and you could also consider treating some of those exposed short 85 puts as cash secured. The way I had defined earlier, you might think if the stock really does go all the way down here into the low 80s, I'm comfortable buying some shares there. So you sell 10 of the 85s, 10 of the 90s, you buy 10 of the 95s, and maybe you buy 5 of the 80s. And if you're assigned on 5 of the 85 puts, you're comfortable with that. that might be something else you do to improve your cost and not buy as many of the highest volatility level option within the spread. Lots of variations there. That was a lot to follow, but the key takeaway for those of you new to Iron Condor that didn't maybe even grasp some of that, options are flexible. You can do all sorts of different things, and if you understand a strategy like the Iron Condor, then you can do all sorts of different things once you implement it in a live account. Change the strikes, change the width, change the quantities, maybe leave one piece off. You can do all sorts of things to tweak that strategy that fit your market outlook just a little bit better. And that's across the board. Iron Condor, or really any strategy with options. You can change the classic definition and do something just a little bit different. Okay, that went a little longer than I expected, but hopefully it was useful for you. I'm going to bring Ken Keating on here in just a second to talk about some questions you've had during the presentation. Here's our website again, our email, options@theocc.com. Send the team an email with anything you want to know about options. Just don't ask us for advice. We can't give you that, but ask us any questions you would like. And then our YouTube channel is very robust with plenty of previous webinars that we've had. And we record these sessions, and you can see a lot of our previous webinars on YouTube. And then, of course, follow us. Find out what we're doing, what events we're working, where we're speaking, what we're doing. Follow us on Facebook. Follow us on Twitter. Many speaking events that our team does. Follow us and be sure to join and attend those events that we do for various firms and hosts around the industry. So we've got roughly 10 minutes to go. I will first do a sound check. Ken, are you there with us?
I am, Ed. Can you hear me okay?
Good. Yeah, you sound good. Thanks for joining the Q&A to help me out with this a little bit. How has that been going? What kind of questions are you getting there from the audience?
Yeah, well, we've been getting some really great questions. It seems like our audience is constantly getting smarter and smarter because they keep asking better and better questions. But some of the questions that we're getting, for one, for instance, so how should Iron Condors best be monitored in order to close one side and avoid a max loss? Like how, in terms of position management, how should we be looking at managing if we're getting tested on one side? And I'll say one thing, when we look at when we take in a credit for doing an Iron Condor, like the example earlier where it's a 305 credit, that's the most we can lose. And if it's a $5 wide Condor, then the most we can, that's the most we can make. And so the most we can make is 305, the most we can lose is 195. So we've already defined the risk on our trade. So that being said, that those maximum P&Ls are really only occur at expiration, because until expiration, those options will retain a certain amount of time value. But do you want to address maybe managing the position a little bit, Ed? If you're testing one side.
Yeah, your point there was really where I was going with it too. When you enter into the spread, you know your max gain, max loss. You're comfortable with that. You should be comfortable with that when you're entering the spread. Now, if you see one of your sides being threatened and you do feel like, well, I don't want to take that max loss, what you would really be doing, first of all, is continuing to evaluate where do you think the stock is going, because you would expect it to fluctuate. It's not going to sit at the same price one day to the next to the next. So continue to evaluate, do I think it's range bound? Is it going to maybe bounce the other way in my favor where these strikes go out of the money? If you have changed your opinion and you no longer think that's the case, well, then your market outlook has changed. And the position that you have, the Iron Condor, would not be consistent with the position you have. Now, we don't tell people what to do, but we always say, whatever position you have at the outset, as you manage it, as you tweak it, it's generally considered a good idea to make sure whatever you have is consistent with what you think the stock is going to do. So that's the first other thing that comes to mind, Ken. If you do take action and you close out one side, what's one of the worst thing that can happen is you close one side, you pay for that, you leave the other side open because it's not threatened, and then all of a sudden the stock turns around and starts threatening that spread as well, and now you got to close both of them out, take a much bigger loss than your original construction of the spread turned out to be. So I guess the biggest thing I say is watch the stock, continue to evaluate what you think about it, and then translate that. Is this Condor still the strategy that I should use, and then manage it appropriately from there?
Right. I mean, your point is really important about really most people who put on these positions have an idea. They have a forecast for the stock. So if that changes, then, depending on how your forecast changes, you might roll up the untested side. You might roll up the tested side. You might roll the whole Condor up or down, or you just might take it off and live to fight another day. So it really just depends on your forecast. That being said, we started getting questions also about implied volatility. So typically, people who put on iron condors, you're selling two credit spreads. So you're a net seller of premium. You're taking in a credit. You're getting paid to put on this position. And usually people will do this when implied volatility is elevated. In other words, option prices are expensive. So, one of the questions that came in was using implied volatility prior to expiration, how does managing the risk of a rising stock price or a rising implied volatility, using volatility, how is that going to, how can I use volatility to manage my trade? And I guess this really gets back to, this is still all about position management. Obviously, when you have an iron condor, you're short implied volatility. So if implied volatility goes higher in the near term, it will hurt you a little bit. But the risk-defined nature of that trade still exists. If you sell that iron condor for 305, the most you can lose is still 195. That doesn't change. But there might be some noise in the interim as well. So anything you want to add to that, Ed?
Yeah, I hate to sound redundant, but you were saying it, first of all, when you put that trade on, you know what your max gain, max loss is. You're comfortable with that. Now, if you are trading the iron condor because you're using a vol analysis, you're doing maybe an analysis of IVol rank, IVol percentile, or something else, and you're developing an opinion that implied vol is elevated and it's going to, say, gravitate down towards a long-term mean or a short-term mean. It's just too high right now, and that's why you've done the trade. That's your motivation of the trade. If it starts to get threatened because implied vol is going higher, just like I said before with stock price moving, continue to reevaluate. And if you truly, honestly feel this implied vol is just simply too high, I'm sticking with the trade. Or if something has changed, maybe news has hit the wires or an announcement has just been scheduled, something has just been changed, maybe it's a stock price movement that has changed your opinion on what volatility could be between today and expiration, and no longer do you think it is going to gravitate down, then you can manage out of the trade. And then certainly with either one of those, whether it's stock price movements, implied vol movements, if you've set yourself a level so that this iron condor value goes to this level, I'm out of this trade regardless of my opinion. I know me and you, Ken, we've all been there where we've said, look, I got to get out of this trade if I've lost X amount of dollars, and I don't care how confident I am. I have to manage. You're managing your position against what you think is going to happen in the market. You're also managing dollar bills. And if you lose a certain amount, you might need to pull the trigger and get out. But again, it all comes down to what is your true opinion of what vol is going to do in the future, and then make sure the position you have on is consistent with that.
Correct. I think we have time for probably one last question. So somebody was asking about, at expiration, how is it possible that an out-of-the-money call or put, or option for that matter, can be exercised or assigned after the close? So, and this is one thing that's really important about anybody who's trading spread. So the idea that a spread, it's a defined risk trade, but that's only within the spread itself. So an exercise or an assignment can throw off the defined risk nature of that spread. So there's something called an exercise cutoff period. So let's just say you're short the 100 calls, stock closed at 99, and you didn't buy it back, and you just thought that the option's going to expire worthless. And then all of a sudden you wake up on Monday morning and you found out you were assigned. Well, there's a cutoff period for your broker. So every broker has their own cutoff period. And I've heard of cutoff periods being as little as 10 or 15 minutes after the close. So if somebody who's long that contract decides to exercise their contract, they can still exercise that contract as long as they get their notice into their broker by their broker's cutoff period. And it varies from broker to broker. But this happens a lot because stocks sometimes move in the aftermarket. So, we can't talk about specific stocks, but there was one notable stock earlier in the year that people were short a lot of bull put spreads, and their put spreads closed out of the money. And then all of a sudden, some news came out after the close. The stock dropped $100 on expiration Friday, and people woke up on Monday long a lot of shares because what happened was their short put got exercised. They didn't exercise their long put, and boom, now you have a problem. So once again, the way to mitigate against that is to buy back your short contracts on or before expiration. But once again, that's an individual choice. But you want to add anything to that, Ed?
No, you covered it, and I've got our contact information back up on the screen for anyone who needs it as we close it up. But yeah, just emphasizing the importance of understanding when you're short options that the holder of that option can exercise for whatever reason they choose. They can look at after-hours activity, and if you're short, you have an open assignable position, something unexpected can happen. It doesn't happen often, but it can happen, and for those of us in the market long enough, it does happen, and you want to make sure that you cover that and can handle it. I understand everyone wants to squeeze out every penny. I do that as well. You don't want to necessarily pay a nickel or a dime to buy back an option if you don't have to, but sometimes an investor might consider it worth getting rid of that assignment risk, taking that off the table, and moving on to the next trade. So I want to thank everyone for tuning in today. Again, please reach out to the team. We're here to help. That's what our jobs are, and we enjoy it. We love it. So please reach out to us with your questions. Contact us. Take advantage of the investor education team. If you haven't already, please fill out the survey attached to this presentation. We look at every single comment that comes through to evaluate our program and make decisions moving forward. So please take the survey, send your feedback to us, and sign up for November. OIC instructor Mark Benziquin will be doing a special fun session in November on frequently asked questions, and we'll bounce around different topics that investors are consistently asking about, and he will explain and answer those questions. Should be a fun session in November. Find that in the events section of our website, and be sure to join. So once again, thanks everyone for tuning in, and we will see you in a month.